Hey everyone, welcome back to the deep dive. We like to get to the bottom of things here, uncover what's really going on. And today we're tackling something a lot of people dream about, especially in India, early retirement.
Absolutely. Financial freedom, choosing how you spend your time. It's a powerful idea. We found a great article that lays out a roadmap specifically for achieving this in India, so let's break it down.
Sounds good. I'm ready to dive in. So, first things first, the article makes a point of defining what early retirement actually means, because it's not always about stopping work altogether,
Right.
right?
It's more about achieving financial independence. You're not tied to a job out of necessity. Your investments and other income streams cover your expenses. It's about having the choice to work or not.
That makes a lot of sense.
Yeah.
And to get there, it seems like saving aggressively is key. We always hear about putting away 20%, maybe 30% of your income, but this article suggests aiming much higher. Yeah, if early retirement's the goal, 50% or more of your income is what they recommend. I mean, think about it. The more you save, the faster you build up the capital you need to become financially independent.
Makes sense. But then it's not just about saving, it's about investing that money wisely. The stock market's mentioned as a powerful tool. The article points out that historically, the Indian markets delivered returns around 12% to 15%.
Yeah, India's economy is growing. There are demographic advantages. That contributes to its strong performance. But it's important to remember that past performance doesn't guarantee future results, and the market can be volatile. So the article recommends focusing on fundamentally strong companies or looking at index funds for long-term growth.
Right, diversification is key. Now, mutual funds are another avenue highlighted, specifically SIPs. Why are they so effective?
Well, with SIPs, you're investing a fixed amount regularly, regardless of market fluctuations. So you end up buying more units when prices are low, fewer when they're high. It's rupee cost averaging.
And it takes the emotion out of trying to time the market.
Exactly. It enforces a disciplined approach, a consistent investment habit. But the article doesn't stop there. It also explores real estate, particularly in developing areas.
Yeah, the potential for good returns is there, and then there's the possibility of rental income too.
Right, you've got potential capital appreciation from the property's value going up, plus a stream of passive income from rent. But it's important to remember that real estate also comes with its own set of risks and requires careful research.
Absolutely. Now, the article also touches on some lower risk options for a balanced portfolio, things like sovereign gold bonds and fixed deposits.
Yes, those can provide stability, especially for folks who are more risk-averse. And there's even a suggestion to think about investing in side businesses or startups.
An interesting idea to generate some additional income. Now, beyond investing, one of the secrets the article highlights is the importance of living below your means. It's not just about how much you earn, right?
Exactly. Avoiding lifestyle inflation is huge. As you earn more, you don't automatically increase your spending. It's about staying mindful of your expenses, focusing on value. Those are habits the article associates with building wealth effectively.
And to reach that point of financial independence, building multiple streams of passive income is crucial. The article gives some concrete examples.
Things like dividend-paying stocks, which we've talked about, or rental income from properties. You can also look at online businesses like blogs or YouTube channels. And then there's always freelancing or consulting if you have skills to offer.
Diversifying your income sources like that adds security and speeds up your progress towards financial independence. So, how do we know when we've reached that point? The article talks about the FIRE number.
Ah, the FIRE movement. Financial independence, retire early. The basic calculation is pretty simple. You take your annual expenses and multiply them by 25.
And that magic number tells you.
It tells you how much you need invested to potentially live off of returns without depleting your principal. The idea is based on the 4% rule. Historically, you could withdraw about 4% of a well-diversified portfolio each year, and your investments should continue to grow. So the article gives an example. Let's say your annual expenses are 5 lakh. That means you'd be aiming for 1.25 crore in investments to achieve FIRE.
Okay. And then the last point the article really emphasizes is consistency and patience. This is a long game, right?
For sure. Early retirement, financial independence. It's not a get-rich-quick scheme. It requires a mindset shift. You're committing to saving diligently, investing consistently, and having a long-term perspective.
Right. And time becomes your friend. Starting early, even with small amounts, allows the power of compounding to really work its magic.
Right.
So to sum it up for our listeners, the path to early retirement in India is a combination of things. Aggressive saving, smart investing across a range of avenues, being mindful of expenses, creating those passive income streams, and of course, understanding your FIRE number.
And maybe most importantly, It's about deciding that financial independence is a priority for you, and then making conscious choices today to create that future.
So for everyone listening, what would financial freedom allow you to do? What would you create? What would you explore if you had that time and flexibility? Maybe start by calculating your own FIRE number. See what it takes. That could be the first step on your journal.
It's a powerful exercise to go through, that's for sure.
It definitely is. All right, that wraps up our deep dive for today. Thanks for listening, everyone.
Thanks for having me.
And we'll see you next time on The Deep Dive.